Yeah, good morning. My name is Richard Bentley. As this is going to sound weird now. As Richard said, sorry, I've got to chunk my another way of saying that. As Richard said, I'm responsible for the UK real estate finance at Helaba. Helaba is a German-based bank. We cover a number of business areas: corporate finance, asset management, retail, and of course real estate. Germany is our home market. Half of what we do is in Germany. Outside of that, we have branches in New York, London, Paris, and Stockholm, and we operate in a number of other continental European markets as well.
Good morning, everyone. I'm Alexander Fischbaum, advisory. Maybe a little bit about my background. I came to the UK 20 years ago, started to structure funds for ING, having worked in real estate in Germany before. Then was at Barclays, head of real estate mezzanine, worked in Barclays Capital, and then was in a private equity firm for a couple of years, Orion Capital Managers. And 6 years ago, I set up AF Advisory, and we're a small team, and we're trying to bring the private equity and investment banking style of sourcing, execution, and asset management to a wider range of investors, which we take with us into the UK and continental Europe as investor sources, financiers, and asset managers, which we all provide. And on this, we are quite sector agnostic and we are country agnostic. We just look for relative value, and if we can match the returns to the expectations of our capital. So, for example, earlier this year we've bought for Anglo-Saxon UK Capital a value-add asset just outside the city of London. They could stomach the political risk, they could stomach the one-year weighted average lease length. And then we have Asian capital, for example. We have worked with a couple of Koreans who did not like those characteristics in the UK market at the moment. So we went with them to Amsterdam because we saw relative value there and bought a big, well-let office asset with some core plus value-add elements on it. So we try to match in Europe what our investors want us to find for them.
Great, Richard.
Hi. Hopefully most of you know Colliers, but we're one of the top real estate advisory firms around the world. We're listed, so we're owned by Canadians and listed on the Toronto and the NASDAQ stock exchange. We are the fastest growing capital markets business around the world. We were an affiliated business 10 years ago. We're now buying in, and from an EMEA level, we now control 90% of the revenue. From capital markets, I head up the cross-border capital markets team for the EMEA region, which I've been doing for 6.5 years. I'm based here. I add values to the teams by knowing and having access to global and regional capital sources.
Great.
Hi. My name is Ekaterina Avdonina. I'm the CEO and co-founder of MIRASTAR. MIRASTAR is a specialist logistics investor, asset manager, and developer. We're a pan-European player. We were formed this year, it's been quite an exciting year, given that all discussions we had just now about where we're in a cycle. We definitely still be believers in the sector, in the space over the next decade or so. I've been in the logistics space for over 11 years. Prior to forming MIRASTAR, I set up another business in 2010, so I've definitely seen the changes and the transformation in the sector since sort of the previous recovery periods and up to now. And we have offices as MIRASTAR in London, Rotterdam, and Madrid. So we're covering Southern Europe and Western European markets from our regional offices. And MIRASTAR is a joint venture between the management team and M7 Real Estate, which is a pan-European fund manager. So we also benefit from sort of our joint venture partners' expertise and understanding of the pan-European trend. So excited about the panel.
Great, thank you. Richard.
Yeah, Richard Pilkington. I'm the head of CAIN International's equity investment business in Europe. I've been with CAIN since 2015, so the past 4 years. Prior to that, I was Oxford Properties UK Managing Director from 2010, so we were through Oxford's growth, the primary growth years in Europe. And prior to that, I was with a group called MGPA, who were a pan-European, pan-Asian private equity investor. CAIN was formed in 2014. CAIN is back, is a privately controlled investment firm. with activities in Europe and in the US. We have three strategies basically. We lend into real estate, we will invest into real estate, and we will also invest and back what we've seen as lifestyle platforms. So we have a number of positions in that. And the business has grown really from nothing in 2014 to having invested across those geographies just over $5.5 billion in that period of time.
Let's just pick up the interest rate question, because obviously there's been a big change. I mean, maybe Richard Divall, let's pick up with you. Just at the beginning of this year, when we had a similar discussion around the outlook, everybody was expecting the interest rate cycle to change, starting in the US and then moving through. What's your sense of that? Because that suddenly changed over the summer and we began to look at this much lower for longer position. How's that influencing, I suppose, what you're seeing in the market and the market going forward?
It's you're right. This time last year, we all thought North American monetary policy was going to come to Europe and interest rates would rise. And clearly now we're seeing European monetary policy move back to probably North America. What it does is, as you say, low interest rates. It's great for real estate. It makes it a very attractive asset class along with infrastructure. And I suppose the big shock I've seen this year is, everyone was talking at 3% last year, and now we're actually seeing sort of 2.5%. So, pricing for core product is going down, and dare we say it, we're actually seeing yield compression in places like Germany.
And feel free to pick up that point on interest rates, anybody. But also, when we're looking at those sorts of yields, from a banking perspective, or when you're getting down to that kind of sub 3% level, how do you see that?
So it makes life a little bit more difficult for us, I think. Not least which because we also take deposits in euros, so at negative interest rates, we're placed with the ECB. I was looking at your forecast for Germany. I think we're probably a little bit more ambitious, but possibly only by a couple of bips, really. So we do see a little bit more growth coming into the German economy, but I would say it's not getting sunny anytime soon over there. We do expect probably Christine Lagarde will come in with a further rate cut, probably earlier next year, and then we see nothing for a while, we hope. But it's painful when you're trying to underwrite real estate. I guess senior debt lenders are underwriting up to 60-65% maybe. You're looking to get some sort of long-term feeling. There's always a gut feeling in real estate lending that if you could get to a break-even position as a yield on debt of 8%, you were good. You were going to be good. If you want to do that now, you're probably not actually going to be putting any money out the door. It is getting more and more difficult. So I think lenders are having to revise how they look at it. We always seem to compare historically how it always was, but really the negative interest rates really have to fundamentally change the way we've got to look at things. So the 8% is no longer 8% from a banking perspective. We're probably underwriting that to 5 and feeling that's probably moving towards 4% really. So it makes life more difficult. And then when you think about projecting the interest rate rises into the future, what is that going to do if I put a 5 or longer loan on the house? It does make life definitely more challenging.
I think this negative interest rate issue is really the key driver of everything. And also, if we have returns of yields at 3% or more, we've more than once this year had terms for 60% LTV. We're quite good at sourcing that, or far below 1%. So if you get money that cheaply, you can buy at a 3% yield and you have still a very good carry. Should you is a completely different question, but you can. And taking a step further it's all about pressure of capital, because these low interest rates that the ECB set politically rather than economically, if I may say so, drive people out of bonds where they get negative money. They drive banks into a situation where they give us and our clients either debt at a yield far below 1%, or park it overnight at the ECB at minus 0.6%. So there is, I'm quite happy that I'm out of Bentley nowadays to be happy on that side. And as long as this prevails, too much money around, very few alternatives to put it, that's going to drive prices forward. And I'm a little bit worried about the reversion, how this is going to look like.
I think it's a few things. As we just said, you've really now got real estate as seen as an absolute permanent asset class. So people do not trade in and out of it as they did historically, which means there is less volume. There's lots of other things. What you've also got is, if that is an alternative to bonds, you've now got people saying, right, the demand therefore for that core stabilised income is enormous. And that's ultimately one of the things that is driving the prices and the yields down and down. But if you think about that, so what is the opportunity? Well, when you look at those, a lot of those capital sources that are seeking to buy that yield, most of those capital sources are not comfortable going up the risk curve. So where is the opportunity? Well, the opportunity is in the value add space, it's in the opportunity space. Our strategy is to reposition, develop to core for the benefits of those investors that will not go up that risk curve. And I think when you come to the lending, to Richard's point, and one of the Richard's points, you sort of got to, the banks, in my view, they've got to reinvent themselves. They've got to think, well, how do we do it differently? How are we going to make a margin on our money? As you say, you've got negative interest rates. And I think what you have seen in the last 4 years is a huge emergence of alternative lending. We have an alternative lending strategy. Blackstone do, Starwood do. We just arranged a loan with Starwood. And what people will pay for is, they will pay for the flexibility. They will pay for a loan that's, we were talking about this earlier. And I think that's where you've got to fundamentally see that the lenders come in a different way. It might be easy to lend to a core product, but then if the banks go into that value add space, that's where I think you can start to see, actually make those margins.
Yeah, I think that's right. I think to stay in the business really and to do well, you've got to look at, there will be a mix because you're not going to be able to sell your credit committee, high risk on everything you're doing, so you are going to get a blend, but I'm going to feel that Helaba is seen as a conservative organisation, but I have been pushing the envelope of what we were looking at while I've been there. And there's much more operational risk coming into the assets, which I think generally seems to be coming into the real estate market anyway. And that's something that lenders have really got to get their heads around of looking at that and trying to get themselves comfortable. There's no long-term cash flow going to be absolutely guaranteed. There's no long-term leases. If you did have a long-term lease, a number of the corporates are also feeling the stress. So you've got to get into a different space, I think, absolutely.
Okay, good. There's a couple of questions coming in on Slido, and I'll pick those up, one of which is on impact investing, and that's an important topic that's getting raised more. But I just wanted to pick up with you, Ekaterina, just when you're looking back at 2019, what do you see, I suppose, in your sector, particularly some of the key changes that you've seen?
Yes, sure. On the logistics, I think it's fair to say 2019 has seen lower volumes of investment activity, but that's primarily due to the fact that some of the big corporate deals took place in 2018. I'm referring to Logical, P3, Sale. So in 2019, we haven't seen these big platform deals happening, and hence the volumes have come down. Also, there's generally been a lack of stock for sale. Generally, the landlords of logistics assets are not willing sellers in this market, primarily because it begs the question, where would you reinvest? If you're sitting on a sort of well-performing logistic asset, which is probably generating you anywhere between 5 to 8% cash on cash, with modest leverage terms that normally core investor would put in it, you don't have a lot of alternatives to reinvest that sort of and generate that sort of level of cash on cash. And with very positive rental dynamics and rental growth dynamics, again, it generates very limited opportunities for a lot of landlords. And so there haven't been really willing sellers. I think a lot more groups have gone into development this year in logistics space, but that's going to take a little bit longer before the volumes and the stock will be put back in the market. And hence, this is the reason why we've seen sort of a real slowdown in activity. However, on the flip side, on the occupier side, we have seen an increase in take-up in every single national market, including the UK, which is very surprising, but it is the fact. we have seen generally very positive and very healthy occupied dynamics. And the rental growth, and a very positive rental growth forecast. I mean, we see rental growth in Germany, not in Munich and not in Hamburg, but in some regional markets. And that is primarily to do with, tightening of the lending market for development. I mean, it's still impossible to find funding for spec sheds development. I mean, you will have to go to alternative lenders, and they're very selective to the groups they want to work with. If you have a good kind of corporate story and a good track record, they'll probably lend you, but the cost of that capital is still quite high. But the traditional groups are not there, and which creates, again, I completely agree with this Richard on my left, that they're going to reinvent themselves. I think the lenders are somewhat responsible for this tightening of the cap rates in the core space.
Blame the lenders again.
You're at that end of the table.
10 years ago, I seem to remember a similar story.
I can tell you it all went wrong because of you.
Good.
It was the ex-lenders we blamed.
I mean, that's. I mean, logistics has been one of the big trends this year, particularly, and I've noticed in the PwC ULI trends report that's coming out or has just come out, that logistics is back at the top of those, and then the rest of it is really made up by living parts. But one of the, I mean, just picking up that point that came in about impact investing, ESG has been one of the biggest sort of topics that we've seen coming in terms of events. We did one a year for the past kind of 5-6 years on sustainability, and then this year we did almost 4 at Expo Real, and it's come up into almost every single topic that we've done. And there was the mention there from Richard of the amount of...
Poor Richard.
I'm sorry. I was just trying to introduce another Richard. That would be, We heard from non-Richard number 3. We heard from Damien about the amount of capital waiting for that sort of sustainability, ESG side of things. How important do you see that from, I suppose, from anybody's perspective? Yeah.
Can I stop? Because I think that's hugely important. I think you say waiting. I think, to me, it feels like capital is so politicians like to do things and like to change things. It's only when the money makes a decision to do something that things really happen, I feel. And it just feels certainly over the last 12 months, that shift is really coming. From my perspective, I'm very alive to this subject. I want an environment that's going to be there for my children, etc. But I think also, when you hear the noises coming from Mark Carney at the Bank of England or Christine Lagarde now at the ECB, where it is definitely up there on their agenda. That I think, I'm not saying it's going to happen, it's not any house view, but I wouldn't be surprised if we saw that ESG is going to become part of how we rate, so therefore how the cost of our capital that we're going to be assigning to those loans. I think that, if that happens, then the lenders are going to be behind this. Investors, I think, probably are ahead of lenders at this point in terms of their view, because it's not just the environmental, it's obviously the social, and it's obviously the governance as well. But do you want to be the person left with a building that is no longer lettable? We're seeing the tightening of the conditions around what you can let and the emissions on that. So I think it's going to be a huge area, really huge area for us. So if I was asked for 2020, what would be my big thing? It's that, apart from the fact, the B word, and then the 2020 US presidential elections. But I think it's going to be very important.
Okay, good.
Yeah, I just wanted to make a point. I think it's really interesting in our space that the occupiers are ahead of investors and secondary lenders. That we see every one of our logistics large occupiers. They have a proper agenda. It's been going on for quite a few years. Labour and the fight for labour in logistics space has been a real theme. I mean, with unemployment rates sort of close to structural levels across most of the market, with a few exceptions across Southern Europe, I mean, the fight for labour has been really a big theme for a lot of occupiers. And so as a result of that, they had to really tighten their social and environmental impact agendas. And it's really interesting. I mean, there's no other way but to build a fully sustainable building in logistics these days, because you have to employ, our occupiers employ anywhere between 500 to 2,000 people per site, per large distribution center. And, the environmental impact that building will have, the environmental building and the policies around, social economic policies around that building, are hugely important for our occupiers. So I think it just comes as a completely standard package these days in logistics as a result of our occupier needs.
Yeah, I was at a conference in the US last week, and this was a massive agenda item, and somebody did ask a very simple question, put their hand up and said, what does it mean? Like, what is ESG? And I think it's interesting, because if you go back 20 years, the construction industry in particular 20 years ago was at the forefront of trying to start with modern methods of construction, investing in the local communities they were in because they disrupt them. So they were organisations who were already doing some of this stuff. And somehow we've developed this word ESG, and it's now this massive agenda. And I think what you've got to do is sort of clarify, well, what are the various buckets of that, and where can you actually make some impact? And I think to Richard's point, what we've seen, we've been talking to investors kind of across the world, particularly in the Middle East and the US, and what you're seeing from sovereign wealth investors and from big pension funds, they are starting to use this as a method of screening in terms of what capital they give to investors. The issue they've got is that they're not sure what criteria to put to it. So what are they testing you on? And one of the easiest tests is if you are delivering things, physically delivering, and you're delivering new buildings, it's kind of an easy test, because as Ekaterina just said, you've got to deliver these buildings in that way. The issue is then if you've got a refurbishment program, you're dealing with obsolescent buildings, what do you do with them? Because you can't turn them into the same thing. It's just not possible. And then for banks, what do they do? How do they decide? Are they going to say, well, actually, you don't meet this criteria, so we won't lend you the money? I think it's a very big, challenging agenda.
Yeah, I think you might see a differentiation there. I recognise if you're building a brand new building, there are the standards, and everybody's aiming for outstanding, etc. But the point about it is, as an industry, we need to move something forward. So we can't say it's difficult refurbishments. We need to come up with a way of saying, how do we improve? It may not be taking it to the standard of a brand new building, but it's moving it forward. And I think that is going to be something that we need to figure out how we can measure, because if you look at the EU taxonomy at the moment, they recognise that measuring what we do with buildings is very difficult, because it's about greenhouse gas emissions. Well, how do you really measure that? And it's something that, I guess technology needs to evolve in that. But we can't sit still and wait for it to happen. We need to do something now. I don't necessarily think it's going to be a screening process by the lenders to say it's a knockout criteria. If you've not got a green building, we're not going to finance it. I think it will be more refined than that. I think overall the equity that we put behind our loans will probably remain the same, but there'll probably be a slight benefit if it's a brand new building, and then maybe it's slightly more expensive if it's not. But if we then structure our loans to say, if you do improve it, then there is some benefit to you in that, then I think that's the way the market should be reacting to it.
I just wanted to pick up on also a couple of questions which were in this. Buildings account for 40% of greenhouse gas emissions. What's the strategy to improve its efficiency? Is it via expensive capex or technology? And also the one on impact funds was how are you producing, advising, sourcing impact funds and products for investors, because it's their biggest hot topic. But yes, that. I was just you don't need to answer all of those. I was just going to pick those all up quickly.
Right, I picked the microphone up exactly at the right moment. I'm not going to say anything about impact funds, because some of the things I don't get my head around. But on the environmental side, I think this will be driven more by the consumer. It will be driven by the occupier who says, well, for my corporate records, I want to have an energy efficient building. And we look at that very carefully for all our clients for two reasons. A, there's operational cost. If you spend a lot of money on heating and all other things, there's less remaining for rent. So that is important. Secondly, it will be also a talent sourcing exercise. If you, for example, have a inefficient building that's drafty as a logistics shed, then your staff may go to another place, especially in the winter in continental Europe where it can be freezing cold. If you have an office building that's not properly working, you may have retention issues with your key talent. So that will drive it. I think it is more a bottom-up process where the consumer says, I want to have this kind of quality for my asset, and that's going to drive rents, desirability, that's going to drive, as Richard Pilkington said, can you sell it? And afterwards also, can I sell it, can I occupy it? As Richard Bentley said, can I finance it? So it's a bottom-up project more than a top-down, in my view.
And we've also got, so we've done a couple of things, because the alternative sectors, again, in the ULI PwC trends have come through in the top 10 very, very much, in healthcare, senior living coming up a lot more in that. And that's something where that's been getting some of the impact investment aspects coming into it. Richard, are you seeing, obviously you're talking to a lot of international capital about opportunities, this sort of, although it's a small part of the market at the moment, senior living, healthcare, which can be around that impact investment side, are you seeing that becoming more attractive, and is that part of the reason?
Yeah, no, and definitely. There's cradle to grave. From nurseries all the way through to senior living is very, very popular, and it's slightly higher income yield for long income, stable income. It's very defensive with the demographics. And I think, whether you're talking to North Americans, whether you're talking to someone in Singapore, they seem to understand it probably better than the Europeans, actually, and are certainly driving and looking at that. So, I think Chinese senior living is very, very important to the Chinese. So I think when the Chinese capital does come back, we'll see a lot of money going into senior living. But, the Singapore groups have hugely gone into student housing and have been for many a year. But we're just getting more and more players coming into that. And I think, the Japanese money that's just starting to come seems to be very residential focused. Yes, it is buying commercial, but it is probably more money wanting to go into those alternative property sectors.
Okay, good. I'm going to pick up some of the questions now quickly that we've got here. This one quite specific. Oh, and I forgot to say, some people have been doing it, but if you see a question and I haven't answered it yet, you can like it, and then it goes to the top of my phone, just so that you know. So some REITs are taking action to stop fund leakage. Are we on the brink of pricing being more realistic, or are they still hoping for a post-Brexit rebound?
We're referring to the headline by M&G earlier this week, but as Damien highlighted in his slides, we all think the UK is very good value in comparison to everything around Europe. Since 2016, prices have arguably moved out, and we're the one market in the UK that's done that around the world. So, a lot of international money wants to come to the UK. I think this year we've seen a lot of that institutional money sitting on the beaches, all wanting to come and pay a 5 cap in London rather than the 3% cap in Germany. But it just can't get its investment committee approval. Whether that's going to improve next year, I think yes. I think there's going to be hopefully more certainty if we get the right election results on Thursday, and hopefully that will create some more certainty. But we've already seen DECA come in and buy a logistics unit last week in the UK, and I think you're going to see more of that institutional money coming. The family office money is, the inquiries we've had over the last couple of months, is, oh my gosh, the pound might get stronger, let's get in now. And the family office money that doesn't need institutional committee approval has probably been fairly active around the UK, looking at as an opportune time because the institutional money is not there.
Okay, good.
Yeah, I think when you look at, it's interesting, Damien's charts earlier, if you think about something like Warsaw, where prime yields are 4.5%, or Paris, where prime yields are sub 3%, and we're talking about West End yields being at 4 to 4.5%, it's crazy. And you've got, the group I used to work for, they have been very we will pay 3% in Paris, but we will not pay more than 5% in London. So if you think about it, and there's no question that it's been a sentiment issue relative to the Brexit situation. So if we do end up where David suggested we end up at the end of the week, personally, I think that I think you will see the floodgates open. I think you will see the Middle Eastern capital, the American, subject to where the FX rates are. I think you will suddenly see all that capital that poured in 13, 14, 15 come back, and it will push everything down.
Do you think they will, or do you think they'll actually wait another year until the actual trade deal is done?
No.
I don't.
No. Why? Because there's going to be more competition.
There's so much capital. There's so much capital, and that's the first point that was made. What do they do with the capital? Where do they put that capital to get that yield? Given the bond rates, given the low interest rates. So I think it will be significant.
Yeah. And I think you're also seeing a lot of global capital, does it want to necessarily go to Warsaw and pay 4.25%, or would it rather go to London or New York? And we've seen Samsung and Hanwha buy a building in New York recently, which, there's no currency advantage against the dollar, but it's a 5 cap, and that's very, very attractive to some of this international money. Why pay below 3% when I can pay that in my market that I understand? And I think, every major sale we've got in Germany at the moment, it's all being bought by German money at 2.5% or 2.75%. And quite often we're seeing now that the Germans, because they've got negative interest rates at minus 0.4, using that to their advantage, the cash buyers, on the yield. So rather than paying 3, they think they're paying 2.6. So
you're seeing cap rates in Dublin at 4%. And Dublin's a tiny market, which maybe counts for it. But what in reality it is people who can't buy that product in London go, same rule of law, same principle, it's a hop, skip and a jump away, we'll go and pay that in Dublin.
I'm going to go. So we'll do another session actually, although it's not on the programme yet. We'll actually do another session here in London, more focused on the UK specifically and the outlook in January, when we've then got once we've had the result of the election and also things have settled down a little bit. So that
Did you just decide to do that then?
Yeah.
Because no one can answer that question.
Yeah, I thought it was easy. It's probably easier to do it in January. Good. Let's pick up on. We've got a lot to get through. Goodness. What do you see as the biggest risks for each sector? Retail, offices, and logistics. And there's also a question which we'll pick up in the office discussion, which is about WeWork as well, and whether or not that's changed the market. So anybody can start this on what do you see, I suppose, as the biggest risks at the moment?
Well, I mean, the biggest risks are obviously political. So if we do get if we get a hung parliament, if we get a Donald Trump deciding that he needs to escalate the trade dispute, shall we call it, into a trade war, and maybe that becomes a currency war, that's clearly going to have a negative impact and probably trigger a global recession. That's then going to impact pretty much all of the sectors we're looking at in one way or the other. Leaving that aside, and I don't think that's certainly not our in-house view of what the world's going to do next year, but from an office perspective, the risks are going back to my point about ESG and environmental. I think it probably impacts all of them, so I'll stop banging that drum for a little bit. The biggest change, that we've seen in the last 12 months has been on retail. I think that is shopping centres. That's been very dramatic. I mean, it was happening before, but the speed of deterioration has been staggering. So I think looking at retail and trying to find out how different parts of the retail, and I think there's been quite a broad brush approach to all retail is bad. Nobody wants to touch any retail. I don't necessarily share that view, but a lot of retail's got to find some way quickly of reinventing itself. I think David was saying earlier about shopping centres, obviously the most difficult, but if you're in the best shopping centre or one of the best shopping centres and you've got a very high level of occupancy and it's an experience, you go to Westfield at Shepherd's Bush on a Saturday, it doesn't look like it's got any particular problems. It looks busy in that, and particularly at the moment I wouldn't go near it, but So but I think that there is a risk to retail that we just continue to see it as in a downward spiral, and that's the case. I won't speak to logistics because there's obviously experts, more expert than me on the panel about that.
Yeah, I mean, from the sector perspective, obviously Richard's just talking about retail, but industrial, from a UK perspective, because there's been so much rental growth, I think people are starting to be wary that business rates, so occupier tax, will go up considerably in 2021. So, is that going to mean there'll be less rental growth going forward? I mean, from an office generally, offices is obviously the most popular sector for most investors to invest in, but the one thing WeWork has taught us is occupiers want more flexibility, and I think the capex for offices is not necessarily taken into full consideration by a lot of investors trying to compete and spend their money. So I think shorter leases, larger capex, ESG, etc., is a big threat to the office sector. And then I think obviously residential, what we've seen in Berlin with rent caps over the next 5 years, this whole affordability. What do you do? How do you go and compete and develop residential if you might get the government stepping in and putting a rent control in, for example? So you're probably more well equipped to talk about that, Richard. But
I mean, could you think about residential? I mean, what I think is crazy is whether it's the Tory government or Labour, they put these numbers up and they say we're going to deliver this many new homes. Well, you're not going to deliver anything. You're the government. You're going to do nothing. So who are you partnering with to actually do this? And you think that no one's ever achieved any of the targets, and fundamentally there's two reasons. One is that the underlying skill base that exists across the country just isn't sufficient to deliver it. There aren't enough bricklayers, there aren't enough electricians, fact. And the second is the planning system everywhere across the country, in fact everywhere across Europe pretty much, is so old-fashioned, is so difficult that by the time that developers have just got fed up with it, they just can't work through that. And it's not that they're just trying to make lots and lots of money. We have a residential partnership with Galliard Homes. Galliard is the second largest residential developer in London. We have 25 sites. I'll give you a classic example of how difficult the system is. We had a site in London. The mayor decided to call the site in. It was pre-sold for affordable housing, to L&Q, completely pre-sold for £28 million. The irony is they called it in. We sold it 6 weeks later. We sold it for logistics for £34 million. So they lost out on the delivery of all those affordable homes because of nonsense in the planning system. So I think the big, big risk with residential is these massive promises to deliver these homes that are needed for people, and yet the underlying sort of the underlying infrastructure or the capability to deliver them isn't there. And then secondly, the environment you're trying to put them through, and that isn't there either.
Yeah, I mean, if you say the government delivers, that's where they really need to focus. That's it is planning where all the things we start to look at generally fall down or become very, very difficult. And delay deals, and eventually, in your case, completely change a deal or.
And I was at a breakfast which George Iacobescu was at, and he said categorically, the number of times from Canary Wharf's perspective that they have lobbied and approached the government and all the authorities to try and create those big, strong public-private partnerships. Think about the access to capital they have in terms of Brookfield, in terms of the Middle Eastern capital, and they still cannot get any traction with the authorities and the government in that respect. Crazy.
I wanted to pick up, there was one question which was on WeWork as well, just in terms of if we've got a downturn in terms of the economy across Europe, we've mentioned Germany there, does that mean there are concerns about the trend for WeWork type space? Is there a percentage that people would look at as being ideal versus a risk within any one building? Or is that sort of space going to do well, I suppose, in a downturn?
I think you need to sort of take it away from WeWork. I think WeWork's got obviously had its own challenges. I think someone said before, WeWork has disrupted that part of the market, and I think that's the interesting part. It's not it. I think if you're not experienced with this, people see co-location or co-location offices. There's, you're sharing a desk with a bunch of startup entrepreneurs that like to party and are very loud. I don't see that is what we're looking at here. I see it from my perspective. I'm a reasonable sized occupier in the city, and when I need to look for new space, I've got to think about the fit out, I've got to look for the space, I've got to do this, I've got to do that, I've got to do that, and by the way, I've got a huge bill coming my way day one. Or do I look at that and think, well, I don't mind paying higher rents, I'm not looking to sign a 20-year lease, but I would be quite happy to sign a 5-year lease, say, and I'll pay more because I haven't got to put the money out of the door day one. And I can plug and play. So I can move in, I've not got any specialist equipment anymore, I just need good connectivity. So I think it has changed the market, so I don't think there's WeWork or that type of space is particularly exposed. It does, if you see it as people can move in and move out with 3 months notice, then yeah, that might be impacted, but I think a lot of these schemes are somebody effectively taking a longer lease and then bringing, at a higher rent, bringing in occupiers probably on a single floor basis, but are looking for space for 3 to 5 years. So yeah, I mean, space will become difficult, but I don't think this is going to be an issue.
Yeah, I think there is a little bit of a deception. I think we talk too much about WeWork, which overexpanded and had a failed IPO. That doesn't really say much about the underlying business. If it's properly executed, there would be probably the office group that's doing reasonably well, buying its own buildings now, for example, and others. But there is a saturation point in that market because not everybody likes the environment, not everybody needs that environment, and I think the question is, market for market, there will be a saturation level, and that will differ. The French will probably take a little bit less warmly to co-location. Germans, the younger ones, yes, the older ones still want their nice office and everything alone, which in a shared office is not so the dumb thing. And if you need, like we work 50 buildings in London, or 52 at the last count alone, well then I question whether that is not overexposing the entire market. And then whether one of them has much too much or all of them have much too much, there is simply too much. So in a downturn with long lease obligations and short rents to your tenants who are of mixed covenant quality, I think this is going to be a particular issue for I don't want to mention any buildings, but there are some substandard buildings where they just shoved in WeWork after a fancy refurb, and you looked at the building and said, well, I know it before, it wasn't particularly good, I know it now, it just has a fancy WeWork on it, and I just question on an asset-by-asset basis whether the performance of those assets will really live up to what they are, because if they're not good assets, then simply putting a WeWork or other cooperating office service provider on it really doesn't change the fundamentals of the asset.
I think what you see in the US, sorry, I didn't mean to go. I was saying in the US where we see, you are getting occupiers like that taking space, but they're taking space alongside other normal occupiers who are taking long-term space for themselves. But then they have the flexibility within the building, which a lot of the bigger companies will be looking for. So you've got a project, you need something that's going to take you 3 years, you need an additional floor somewhere. Having that flexibility within a building, I think, is actually really fundamentally important. I think if your whole building is on that model, then yeah, that's probably where I agree with you. I think that's difficult. Sorry.
Yeah, no, the only point I was trying to make, I mean, it's fascinating about the whole WeWork situation and the fallout of grace, because when they placed their bond in 1718, and for the first time their accounts kind of surfaced in the press, I mean, it was quite clear the business is not going to really perform over the short to medium term due to the very low occupancy rates in China. I think the Chinese portfolio at the time was already like 70-75% occupancy rate. The sort of rates of growth and the incentives they were giving to the occupiers. I'm personally, accustomed to some of the proposals that WeWork made to a few exciting startups. Let me put it this way: you don't need to pay rent. I mean, that's the whole. You get, free beer, free booze, and lots of coffee, and rent. That's just an afterthought. And that's the problem with the tech sector as a whole. And there are other businesses out there who are benefiting from lots of cash and the core or tech and their brand name, and that's enough to support any valuation. But I think the interesting part of the WeWork story is more about the transformation of technology of our occupier side. Because I think as a business, when you think about it, the rate of growth that is going on in technology, I mean, it's impossible to commit yourself to a long-term lease. I mean, how can we have a young business, we have ambitious growth plans. I mean, we cannot commit to long-term lease proposals. So we have to, because we simply don't know our headcount. We cannot forecast year on year what will be the headcounts of our business. It all depends on the rate of growth, rate of technology. So I think it's a disruptor. They were fantastic just to show the availability and the demand for that space for new businesses that are not counting on a specific, very kind of linear growth plan, but as a business model, it's obviously been flawed.
Yeah, I think it's the co-working and the short-term leasing is as everybody says, is definitely a critical component of office developments now, and is what the consumer, the occupier wants. I won't comment on WeWork. I don't think everybody knows what WeWork's model is anymore. WeWork is used a bit like Google's used for searching the internet. We have, in Miami we have WeWork on a 300,000 square foot pre-let, and at the stage in Shoreditch we have them on 175,000 square foot pre-let. So we're pretty close to understanding what they're going to do. But what WeWork are definitely doing is they're dividing their strategy into one which is their original concept of co-working, and the second is they're going to attempt to behave like a landlord. So you're going to see them take their spaces and they're simply going to take all that space and they're going to sublet it. They're just going to sublet it, and they're going to sublet it. It's like 30,000 square feet to an occupier on a 5-year lease, rather than that occupier signing up to a 15-year lease. So I think it's going to change, and I think everyone hopefully will drop the term WeWork as a kind of a term for co-working.
Maybe coming back to what Richard before said, I think the sector actually at biggest risk, in my opinion, is the bed sector, especially where residential is concerned. Let's forget about the UK, where if things go wrong, we end up with a Marxist government. So that would drive the money to continental Europe. So this is a country-specific situation. But if you look, for example, into Germany and into France, there's actually quite a lot of unrest from the residents. They can't buy their own homes anymore, so they're forced to rent for longer. And because prices have been driven up by investment, prices for the residential units have gone up, and tenants have to pay more yield. And politicians are not sensitive to economics. They don't care about it. They care about elected. Elections are driven by individual voters, and if they're unhappy about their accommodation and their ability to afford accommodation, that actually is a key issue. Now, we have in Berlin a discussion whether they can or cannot set a limit to rents. That doesn't hinder the Green and Left parties to discuss whether they shouldn't deploy it countrywide. You have in France quite a significant level of unrest again with yellow vests and just demonstrating against everything else. And also in Italy, where the easy win for the politician is to say, well, we're going to cap rents, because that gets me lots of votes with lots of people who live in rented accommodation. And you combine that with a PRS sector that buys in at very, very low yields and an interesting gross to net, because much of the cost, for example, in Germany is not recoverable. I think the political risk on the PRS sector is particularly significant.
Okay, good. I just wanted to quickly pick up. I'm going to try and finish by 15:15 because I know we started slightly late, but make sure there's plenty of time for you to have coffees and private discussions with any of the speakers and yourselves. But just quickly, I wanted to pick up on cities, because Damien mentioned obviously lots of interesting things in the slides. I noticed Athens, for example, suddenly being something that could be attractive again. You're obviously focused in terms of CAIN on gateway cities. Well, just pick up the cities discussion and how you're seeing those from an attractiveness point of view.
Yeah, I mean, we started to grow our strategy sort of 3 years ago out of the UK, I guess, around the Brexit time. We thought we had enough exposure, and our exposure was to London. We have exposure in Miami, Washington, in New York. So we have been focused on those sort of big ticket, gateway cities. So we started to look at, how do we grow our business? So we started to look across Europe, and we really identified two terms. We didn't use secondary, we used gateway and challenger cities, and by that we mean a gateway is Madrid, Barcelona is a challenger city, Warsaw is a gateway city, Krakow is a challenger city. So we've really followed a strategy to look at those two cities, to look where there is that GDP growth, there is that those undersupplied sectors, there is liquidity, etc., etc. So no rocket science, pretty normal stuff. It's relatively defensive at this stage in the cycle, and we've been it's predominantly been an office sector thing. But what we found is that if you focus on a limited number of those cities, you'll find that the challenger ones offer you more value, but naturally there's a bit more risk. But what you find is they have very similar fundamentals, and to Ekaterina's points about the tech sector, I'll focus on one in particular. If you look at Krakow as an example, you saw the differential in yields between Krakow and Warsaw. So what people don't really know is Krakow is a very historic city, wasn't damaged in the war, it's very difficult to develop in Krakow city centre, but it has 120,000 students. It has the highest retention rate for students in Europe because it's a great place to live. So what has it done? Massively attracts the tech industry. So tech industry goes in, they want modern space, they want the space that they have in all the other bigger capital sort of cities, and all of a sudden it isn't there. So there's an opportunity then to develop that space for those people. Why? Because there's a young, capable, intelligent workforce, they want the space, the occupiers come in. That then leads to an uptick in the residential sector, etc., etc. So we've been very focused on, in Madrid, Barcelona in Spain, Warsaw, Krakow in Poland, and in Ireland we would like to be in Paris because it's complementary, it rounds out the portfolio. We'd like to be in Germany, but as we touched on earlier, they're very, very low yielding. Development's very challenging in those cities, and we're really in that, from a strategy perspective, we're in that value-add opportunistic sort of space, so they're allowing us to bring it.
Okay, good. So I'm just going to do the last question that we would normally do. I mean, we've had lots of discussion this year about the B word, so we're not going to discuss that any further. We're going to move to the C word now, which is Christmas. So if for Christmas somebody could get you the best investment opportunity that there was, because that's a question that's got lots of likes on here, which is what is the best investment opportunity? What would that be? What is it you're looking for? Where do you see the best opportunities at the moment? What could you invest in or advise in, or what would you like to finance? What would be the best opportunity? Let's start at this end.
I think, I guess it's slightly biased because it's sort of rounding out our sort of portfolio, but if I could invest in anything now, I would invest in residential in the broad north of England.
Residential in the north of England. Okay, Scotland, does that include that or not?
No.
Not really. Okay, just checking. Okay, good. Ekaterina.
Well, I'm a bit biased as well, so it's going to be sheds, and I think it's going to be development of logistics units in supply-constrained markets, which is going to be every metropolitan area in Europe.
Okay, good.
I mean, Richard just briefly talked. Paris is the darling of Europe at the moment from a real estate perspective. Damien highlighted the infrastructure it's got. It's got the Olympics coming in 2024. Obviously, you're not going to go and pay sub 3% for core products. You don't really want to. But I think all around Paris and those urban areas are a good bet next year for whether that's student housing, whether it's urban logistics, etc. I think that's a really, really good bet. But a couple of new massive developments are going to take place. So, Hafen City in Hamburg, which is Europe's largest mixed-use development. I think that's probably quite a good bet to go for. And I think in North Madrid, they've just got planning consent for Nuevo Norte. Spain, as Richard's invested there, it's still playing catch-up to prices pre-GFC. So I think, following those infrastructure projects, following the big mixed-use developments is probably a good bet. Okay, good. Alexander.
Provided the election goes the right way as we've discussed, then UK would be on the menu definitely, otherwise not. And I wouldn't be too specific what kind of office, probably a preference, but I'd like to have an asset which I can change in a not unsubstantial way. So the 3% net initial yield, 20-year let to a large covenant is certainly not something I would do, but something where you can improve the asset or the tenant lineup or anything else where you can have some active management opportunity to increase rental income and also to shield yourself from any potential yield shift.
Okay, good. Richard.
Sounds like Richard and I need to speak because I think residential northern sound's probably a northern thing, is it, Richard?
Bias, no?
Sort of banging the drum for the northern. So I would agree with that. I think one area I always scratch my head is, I'm a lender, so I'm not the investor, but it strikes me that if we've got logistics at whatever 3-4% sort of here, and we've got retail at whatever, pick a number, but it's probably double digit. And we've got a gap between what they call the last mile logistics. Why wouldn't you look at that area? Because it strikes me if you can get that right and you can deliver that last mile logistics whilst doing something with the retail as well. And you spoke about the omni-channel. It seems to me that there could be a bit of yield compression in there, but I'm just a dumb banker, I don't know.